We are ready to go. All right. Well, thank you everybody for being here. This week, we're taking a little bit different of an approach. Um, Josh and I are partners in a mortgage company, and so sometimes mortgage policy or guideline policy comes down, and we are just forced to deal with it. And there was some policy that came down around any borrower that had student loans and that determined whether or not they could qualify for a mortgage. And it was one of the more chaotic, maybe guideline updates that I've ever run across. And so this topic today is really along the lines of, if I knew that there was an organization like America's Homeownership Alliance where my voice could matter, if I knew where to complain or where to push back on some of this policy, I would have done it in a heartbeat. And only in this last year, from meeting Phil and Brian and Tino and Eric and having these conversations, did I start to recognize that we do have a voice, and that when this stuff comes up, that there is an opportunity for us to push back. Now, I see a lot of these types of policies going to be coming out from the new administration, and they're already coming out now, or they're at least talking about it. So I want to talk about this student loan, how bad student loan policy hurt home ownership, and kind of go through the evolution of how this happened and how it impacted people, and quite frankly, how egregious some of this is, and that I think that it ultimately hurt the people most that needed help the most. So, Josh, you've gone over this a million different times. You actually were the one that came to me and said, hey, we need to create content. We need to write about this. We need to let consumers know. Talk about what happened in 2015 that kind of started this snowball rolling.
Well, we started seeing bigger and bigger student loan balances with smaller and smaller monthly payments, and underwriters on the files began asking questions. Well, what's going on here? Because none of us prior to that point had seen it. The income-based repayment issue was a solution proposed and enacted by the Obama administration. And it doesn't really solve anything. Much like most government solutions, it pushes the can further down the line, because what it does is it makes a monthly payment that the student loan borrower can handle based off of their current income, but it doesn't reduce or eliminate that debt going forward. And that becomes a problem for the lender, because they're trying to figure out what can you afford on a monthly basis. So we don't really have a fixed payment. It changes year by year with an income-based repayment. The student loan borrower has to provide all of their income documentation. If they make less money the following year, the payment can go down. If they make more money, it can go up. So in that time frame, 2015, 2016, when all the agencies, lenders, FHA, VA, USDA, Fannie Mae, Freddie Mac, came to realize this isn't going away. We have large and growing student loan debt. It's not going to go away. So what are we going to do now that the solution for most borrowers seems to be, or at least most high balance student loan borrowers, seems to be an income driven repayment? So we had FHA was the first to say they will allow an income-based repayment, and then they went complete 180 degrees and said they would require a 2% of the loan balance to be used for a payment if it's not a fully amortizing payment. They then switched it to 1%. Fannie Mae and Freddie Mac said they wouldn't use the income-based repayment, and then they switched and said they would, and they've kind of waffled on exactly how it's calculated and what documentation is required in there, and then VA kind of went off and did their own thing. So as you can see, we've got multiple options of common loans for student loan borrowers, and they all treat it a little bit differently, and they've all been horrifically inconsistent in how they've done it over time. So we have this issue that's not going away, tons of student loan debt, increasing student loan debt. The solution is income-based repayment, and once these people graduate, start their lives, start making some money, get married, want to start a family and own a home, we have to deal with it on this end.
Yeah, and I think that, listen, I think there are a lot of policy that, and we've talked about this, that's instituted and they have good intentions, but they're not thinking about the unintended consequences. And so ultimately what happened is overnight, it was, what was it, June 15th, 2015, but it was like right in the middle of June, you had, basically they determined we could have a problem moving forward. There wasn't any empirical evidence because it was basically a normal thing. I think there was still some shock waves from the no income, stated income subprime loans. And quite frankly, and Josh, you mentioned this the other day, and you're completely right, negative amortization mortgages that allow you to make a payment that is less than the principal and interest owed for the mortgage. So the result is every month your mortgage balance goes up. That's exactly, first of all, they outlawed that. That was one of the very first mortgage programs that they eliminated, that they made illegal. So all of those went away. And then 5-6 years later, they create a negative amortization product for student loans. And so they're instantly, I guess the policymakers are looking at that and saying, oh my gosh, these loans are going to balloon and people are going to lose their homes. And what you touched on, Josh, that I think is important. And again, this goes back to, I don't think that why these policies were created is necessarily wrong, but they are definitely mismanaged. And what we're primarily talking about is 5 mortgage entities that are all either guaranteed, insured by, or overseen by the federal government, right? So you got Fannie Mae and Freddie Mac under the Federal Housing Finance Agency. You have FHA insured loans, you have VA guaranteed loans, and you have USDA guaranteed loans. We have 5 separate loan programs, and each of them decided that a different calculation was required in order to determine, and I want to be perfectly clear about this. What we're talking about is the underwriter is going to look at your student loan balance, and even though your payment is something that you can afford, they're going to impose a calculation on that student loan balance that's going to determine a phantom payment that is going to be calculated into your debt to income ratio. So and you're right, Josh. So FHA, the whole thing that triggered this is FHA finally kind of got their policies in line with some of the other more, I think, better policies. But for 6 years, FHA was using what we call the 1% rule. And you're right, for the first year, it was 2%. So let's just look at the 1% rule, because as a result of Josh and I identifying this in 2015, we started on our website, Find My Way Home, we started writing about this topic to help consumers navigate through what was happening. Because anybody that talked to a loan officer that tried to get them qualified for an FHA loan, if they had $100,000 student loan balance, which was not unusual at all, the underwriter was going to apply a $1,000 payment towards their debts. So that means that they could afford $1,000 less of a house payment. But really what happened is it made it so anybody that was trying to qualify for an FHA loan was told they can't buy a home. And they were just told no for no particular reason.
And to clarify why that's important, FHA loans are predominantly used by first-time buyers. It's not a first-time buyer only program, but there's many reasons for that. It's more flexible on debt to income ratios, has a minimal down payment of 3.5% down. We can get lender credits to cover closing costs, and it's far more flexible on credit scores than other programs. So if you went through college and you took out a credit card and you didn't know what that meant and you had a few late payments and you only have a 650 credit score, very hard to get a conventional loan, not nearly as difficult to get an FHA loan. So when every other type of loan had come up with a calculation that enabled income-based repayment borrowers to qualify for a mortgage, FHA was leaving these people out in the dark on this, because oftentimes FHA was the only option that would work from a credit score or a debt to income perspective, but the debt to income ratio is then blown out once you use 1% of the student loan balance. And these numbers vary from where you're at, but $100,000, $150,000, $250,000, $500,000 of student loan debt are not unheard of. We see them regularly. It's another question that we need to have from a policy perspective. Why are we letting kids take out $500,000 of student loans when they get out of college and they make $40,000? We have, on the mortgage side, we have ability to repay guidelines where if you don't show an ability to repay, we're not going to give you the loan. Or if you don't have collateral sufficient, we don't loan you $500,000 on a $100,000 house. But in the student loan arena, we'll loan you $500,000 for a $50,000 degree.
Yeah, and like you said, FHA is largely is widely considered a first-time homebuyer program, and while it's not for first-time homebuyers, it is absolutely the most common loan for first-time homebuyers because it's much more flexible. And to give some sort of contrast here, what we're talking about is whether the guidelines are going to let you use your actual payment or whether they're going to fabricate a payment for you, and under what circumstances. And what had happened is FHA changed their guidelines twice initially. So they initially said 2% of the balance, then they went to 1%. Then Fannie Mae and Freddie Mac both flipped-flopped and said, well, if you're in a repayment plan, but your payment is zero, we will allow it. And then the other one said, we won't. And then they completely switched. And one said, yes, we will allow it. And now the other one said, we won't. USDA and VA are completely different. And, I don't know if consumers really understand this, but the overwhelming majority of loan officers that most consumers will talk to, unless you know them personally and you know they've been in the business, they don't read guidelines. So they don't know that these things are changing back and forth. Josh and I started writing articles about this on our website, which has received one article that kind of lays out all of the guidelines, has received about between 6,000 and 8,000 unique visitors a month for the last 6 years. That's how much confusion there is. And almost all of that confusion is coming from a consumer talking to a loan officer that doesn't know the guidelines. They're quoting them FHA is normally what they're doing, and they're not saying that you have other options. And I put this as a talking point, but Josh, you kind of touched on this. This policy inadvertently has turned away tens of thousands of people that wanted to buy homes that were either quoted FHA, either the loan officer didn't know that there were alternatives to FHA. But this program, I think, hurt the people that we care about most, which are the very first time home buyers, and a lot of minorities are using FHA mortgages because it requires a lower down payment. There's lower credit score requirements for an FHA. So at the same time, conventional credit requirements are tightening, and it's getting harder and harder to qualify for conventional loans, and FHA is just simply not an option at all. So I guess this was where the conversation, this is kind of where the crux of what we're talking about here is that after 6 years, FHA came out 2 weeks ago and they said, we're going to use the same calculations as Freddie Mac. Essentially, they picked one. And they said, we're going to align with how Freddie Mac approaches these. And really, this is the crux of why I wanted to do this topic, is what changed. Absolutely nothing changed. So for 6 years, people like Josh and I have been battling inexperienced loan officers and bad policy to try to navigate home buyers into the right program so that they could be homeowners if they have student loans. But absolutely nothing changed that would cause them to reverse this policy. And that's the reason why I want to have this conversation, because if we would have known about this, and I didn't know about AHA, I didn't know that there were groups that stood up for consumers and would represent consumers against bad policy, but now I do. So I think this is a prime example, and Phil, what I kind of like to get your input on is there's a lot of conversations about equality in home ownership and making home ownership more accessible and more available. We know that the administration has been talking about a first-time home buyer credit. We don't know what that amount is, but we've heard some guidelines, some restrictions on who qualifies for this. And this is just, to me, this is a glaring, this looks to me like it's another student loan bad policy decision that they're going to come out and they're going to think that they're helping people. But those of us that are on the ground, that are actually working with consumers and having to help them, we know that there's going to be challenges. Do you
yeah, Scott, let me,
coming down the road?
Let me first of all of us should thank you and Josh, and I might add, Brian and Eric and others that are acutely interested in these issues, especially going back to the student loan issue. And you put up that last slide that said what's changed, and the answer is nothing. I hope everyone in America knows that this could change again.
Oh yeah.
There is nothing that says they can't flip-flop some policy again. And the only thing that stops that from happening is an assimilation of the voice of the people to be able to make input to policymakers in Washington to just actually, it's almost like grabbing them by the shoulders and trying to shake some sense into their, into their policy process. And I know that most of this is not bad intentioned, but the outcomes are bad. And I just a little track record about this whole thing. And I'm so happy that you've illuminated this student loan issue. It is a prime example of how this stuff happens in Washington with really no one paying attention. I'm going to give you two other examples in a moment, but this whole student loan crisis is also a result of, you could write a thesis about how this whole thing has become has resulted from really government policy failure. The regulators and examiners that should have been really paying attention to the processes, the products, the way that mortgage lending was being done in unscrupulous manner from 2006 to 2013. Unfortunately, because of all that crisis that could have been stopped by government intervention, by intervention. And frankly, if we had had the America's Homeowner Alliance built back then, we might have been able to or curtail that crisis by half or maybe more. The point being, there wasn't a voice to really make policymakers understand that crisis. The result was, from the financial crisis, single-family homeowners in America lost $7 trillion of value from their homes. Well, without that value in their homes, mom and dads that owned these homes had no equity with which to be able to use to help send their kids to school. So, we shifted what was, arguably a challenging policy in itself. And we, instead of, allowing homeowners that had equity in their homes, we dumped all of that student debt on the backs of 18-year-old kids. And that government policy failure has manifested itself into this stuff, which is a bad policy on top of a bad policy. So, I can't thank you enough for illuminating this issue of the student loan debt issue. We're growing this America's Homeowner Alliance. We are going to fix these things. We are going to fix them. I'll give you an example. About 2 years ago, a little over 2 years ago, Congress tried to instill a new cost increase, kind of buried in the legislative language, on every new consumer that got a mortgage over the next 20 years. And it was a small increment of payment increase that was going to go for that increase in payment that a consumer made every month. Would have been stripped away, and it would have been used to pay for the Gulf oil cleanup from the BP oil spill in the Gulf of Mexico. Well, we put our foot down. We got it stopped. We had to rally an alliance of many others, but we did. We got it stopped, and there's no reason for homeowners somewhere to be paying for the BP oil spill in the Gulf of Mexico. This is just another one of those examples, this student loan crisis issue where there's a 2% threshold, a 1% threshold, and then now after 6 years, okay, well finally we'll rationalize this to a threshold that's been used by other government agencies for quite some time, and all those people that were damaged by this, there's no way to for restitution of that process. It's that the only way to stop these things is to have that voice of intervention, and that's why it's so critically important. You mentioned the $15,000 proposed tax credit that's coming for first-time home buyers, and maybe next session we should dig into that, because frankly, there are some really interesting things that we could propose that would make this better for America. We all have the same objective. We want people to be treated fairly and in a justified and sustainable manner. And we want these government policies to meet the needs of the consumer in a fair and responsible way. And if we don't keep our eyeballs peeled on these issues, you've just illuminated what can happen. And so I appreciate you doing that, you and Josh.
Yeah, and in a way that is the most inclusive possible. And the very fact that they isolated FHA, that excluded anybody that we would all probably agree are the ones that need the most help. They need the most financial education. They need the most help with their finances, organizing their finances using, tools like FinLocker that Brian offers for first-time buyers to kind of learn how to set up budgets. Maybe they don't have perfect credit. Those are the people that need to be helped. The people that have 20% down and 800 credit scores, they were already on a path where they received that financial education and they had the opportunities. And so that's one of the things that we're really concerned about. And the student loan thing, you're right, it can flip-flop again. And what I think that people don't understand is even when these policies flip-flop, it doesn't mean that the loan officers in the street know. And that's what we've learned. That's been the most shocking thing to me, is how many people that are supposed to be, they have the title of loan officer or they work with a mortgage company, when probably in reality they just work in a call center at a mortgage company, do not know that these things are changing. So it causes mass confusion within the industry, and consumers simply do not have a fighting chance. And I say this all the time, and it's very, very unfortunate, but a consumer's ability to qualify for a mortgage is limited to the experience of the person that picks up the phone. And that is a frightening concept to think about. But when you have all of this confusion around policy, and again, 5 government entities, it's all the same government. Why did they all decide to address this completely different ways? They're all trying to solve the same problem, some sort of conformity in the way that, but that's just indicative of how the government works, right? It's a 1,000-headed snake, and none of them know that they belong to the same body. They all think that they're independent thinking things.
And Scott, to your point, one of the values, we all have real strong affinity towards FinLocker for that very reason. Just think about that. Thousands and thousands of loan officers not really, being up to speed on the guidelines. That's why if all of them used FinLocker as the tool to provide, the truth serum for the consumer, budgeting, planning, forecasting, etc., on the guidelines that are where there is real truth serum and consistency for utilizing those tools, every consumer would be much better off if they had a benchmark guideline tool like that to use. And so, I agree with you completely. It's unfortunate that the government, these things happen in government policy and government practice. It happens. And when the AHA got formed, we formed it to say that we were going to be, protecting and promoting sustainable homeownership for all segments of America. That meant protecting and promoting against a bad business practice and bad government policy. So, either one. And they both need to be spotlighted and illuminated, and we can make a difference. So, really appreciate you guys bringing that up.
Yeah, well, that's what we're trying to do. We're a handful of voices here. Our hope is that if we keep having these conversations, that more and more people will join us. Please, if you're watching this, either live or you're watching the recording, a membership to to America's Homeowner Alliance is free. There is free lifetime membership. Phil puts out a fantastic newsletter once a month that talks about policies that are coming up. He's got his finger on the pulse of these things, and together we can make a difference. All we need is to be able to communicate with you, to let you know that there's an important topic. And if it's a topic that you're passionate about, or if preserving home ownership or promoting affordable home ownership is something you're passionate about, then you can join us on petitions that we can get into the right hands on the Hill, that we can influence this policy, and we can absolutely 100% do that. My AHA, in its infancy, has already made big impacts on policy in Washington, and we want to turn this into a voice that absolutely cannot be ignored. And the only way we do that is with your help. It's free. It's very simple. Nobody's going to spam you. You're just going to get great information directly from the front lines, and we're going to ask you to join us in this fight to make homeownership more affordable for more Americans. So, gentlemen, if anybody has any last words, we're on our 30 minutes. I think we made our point, and I appreciate you being here.
Fabulous. All good.
Any last words? Okay, good. All right. Thanks, everybody. Please join us on this fight. Join myaha.com/join. And we will see you in 2 weeks with another burning topic and another fight for affordable home ownership. So thanks, everybody. We'll see you next time.
Thank you.
Bye.